You're lying in bed, lights off, phone 6 inches from your face. You open your banking app, mostly out of habit, mostly out of dread. And there it is. Magical 20,000. For the first time in your life, the number in your savings starts with a 2 and has 4 zeros after it. You stare at it a little longer than you'd admit. You feel a tiny bit taller. You start mentally upgrading your life. Nicer apartment, actual vacation, not just sleeping at my parents' place. Maybe even a car that doesn't make that coughing noise every morning. Here's the part nobody tells you. The moment you look safe on paper, the world around you shifts. Your bank suddenly offers a premium card with shiny metal and a higher limit. Your investing app pops up advanced features, margin options, and pro tools. Your feed is full of people your age renovating kitchens, flying business class, buying cars with giant bows on them. Meanwhile, the Federal Reserve's latest survey says about 37% of adults wouldn't be able to cover a $400 emergency just from cash or money in the bank. They'd have to borrow, sell something, or maybe not pay it at all. So, just getting to 20,000 already puts you ahead of a huge chunk of people. That's why it feels like crossing a finish line. Here's the wild twist. For a lot of people who actually do hit that number, their savings are lower the next year. Not because they're lazy, because the rules of the game change right after they win. If you treat 20,000 like the end of the story, you end up on this awful roller coaster. Up to 20,000. Down to 5,000 after a car repair. Crawl back to 18,000. Surprise medical bill, back to 3,000. Repeat for a decade. If you treat 20,000 like level 1, you can set a rule that you don't drop below that line again, and use everything above it to quietly buy yourself time, options, and actual freedom. My name is Joe, and I'm obsessed with how money actually works once you stop living paycheck to paycheck. Everyone online keeps telling you, just get to 20,000, then compounding will take care of the rest. That's half true. The other half is the part that hurts. Everyone says the hard part is getting to 20,000. That's phase 1. This video is about phase 2, why everything changes after that number, and how not to let the system eat it. A quick thing before we get into it properly. I'm not a financial advisor, and this is not personal financial advice. I'm just some nerd who reads way too many reports about how money and incentives actually work. Use this as education and entertainment and as ideas to think about, not as a blueprint for your exact life. If you're making big money moves, talk to a professional who actually knows your situation. Let's start with the part that feels the most personal. You're finally doing everything right. You cut back, you sold some stuff, you took on a side gig for a while, your savings crawl from $200 to $2,000 to $7,500, and then your transmission dies, or your dog eats a sock, or you get that lovely "we adjusted your rent" email. Back down you go. If you feel like every time your savings grow, life just reaches in and takes it, that's not you being bad with money. That's almost everyone. Right now, Americans are only saving around 4 to 5% of their disposable income on average. Official numbers from BEA and USA Facts put the personal saving rate at about 4.5% in 2023 and 2024, which is roughly half what was normal back in the 1960s and 70s. That means the entire system is basically tuned, so most people never wander too far away from kind of stressed. So when you claw your way to 10,000, 15,000, 20,000, it feels huge. You look at that number and think, okay, that's it, I made it. I'm safe now. But watch what happens next. A couple of big expenses hit in a row. You tell yourself, that's what the savings are there for, and you're not wrong. But there's no rule in your head about how low you're allowed to go. So you fix the car, help a family member, upgrade your phone, go on the trip you've been postponing, and you're back at $6,000. You didn't fail. You just treated 20,000 like a destination instead of a line you don't cross downwards anymore. And here's where people start thinking, okay, so I'm broken, I just can't keep money. You're not broken. You just never got the level 2 instructions. So what actually changes at 20,000? Because it's not just your bank balance. Hitting 20,000 is a weird emotional experience. Your brain flips from "I'm drowning" to "I might be okay." You go from panicking over every surprise bill to thinking, annoying, but I can deal with it. At the same time, the outside world flips how it sees you. Your bank flags you as someone worth selling to. Your inbox gets exclusive chart offers. Apps start suggesting bigger loans, higher limits, personal lines of credit. On paper, hitting 20,000 looks like the finish line, but there's a catch. It's also the moment that the money world starts trying a lot harder to separate you from that cash. You notice it in tiny ways. Travel sites start showing you the nicer hotel rooms by default. Your credit card pre-approvals suddenly have 5 figures on them. You tell yourself, I can finally live a little, because you remember how awful it felt when your balance was at $20, not 20,000. Psychologically, this makes total sense. For years, your brain was in, please don't let anything explode mode. You were just trying to calm things down. Now you finally have a buffer. Of course you want a reward. Meanwhile, the system around you is counting on that. Banks don't make much money from someone at zero. They make money from people who look stable but are easy to tempt into long, profitable contracts. That's the rich tax no one calls a tax. And this sits on top of a bigger structural problem. The average person is already only saving a tiny sliver of their income in the first place. So once those temptations land, there's not a lot of extra margin to absorb mistakes. That would all be fine if the math automatically rescued you once you hit 20,000. But the math has its own timeline. Let's talk about that math, because this is where things can start working in your favor. When your account balance is tiny, almost all of the progress comes from your deposits, not from growth. If you've got $2,000 invested and the market gives you 10% in a year, that's $200. Nice, but it doesn't change your life. At $20,000, that same 10% is $2,000. Still not quit your job money, but you definitely feel it. Quick math. If you're putting away $1,000 a month and earning around 8% per year on average, it takes roughly a year and a half to get from $0 to $20,000. That's 18 to 19 months of saying no, cutting back, staying disciplined. And that 8% is based on long-term stock market averages, not a guaranteed number every year. Your second 20,000 doesn't take another 18 to 19 months. It's faster because the first pile is finally helping. Very roughly, at that point, your investments might be adding several thousand a year without you touching anything. Same person, same job, same monthly contribution, completely different slope on the graph. This is where compounding starts to feel real, not just like a meme. And there's an emotional shift too. Vanguard looked at this and found that people with at least about $2,000 set aside had financial well-being scores about 21% higher than similar people with no savings. In that same research, folks who also had 3 to 6 months of expenses saved up saw roughly another 13% bump. Translation: once you've got a solid buffer, your stress drops a lot, and your brain finally has room to think about growth instead of survival. Everyone talks about compounding like it's magic, but there's a catch. If you keep dipping into the pile, the math never gets a chance to do the thing you're counting on. If your account keeps yo-yoing back down every time it hits a new high, it's like planting a tree and ripping it out of the ground every spring to check the roots. Some of you are probably thinking, Joe, I can't even get to 2,000 without something breaking. Why should I care about 20,000 and beyond? Fair question. Here's why. The habits you build of getting from $200 to $2,000 are the same habits you'll need to protect $20,000 and turn it into $50,000 or $100,000. And the world will fight you harder after you look stable than it did when you were obviously struggling. The point of this video isn't to flex a big number at you. It's to show you how to survive phase 1, so phase 2 doesn't wipe you out. Now, let's talk about the weirdest trap I see after people hit that first milestone. You spend months, maybe years, being the responsible one. You pack lunches, you say no to trips, you resist random Amazon orders, you feel slightly boring at parties. Then you see that 20,000 and something in your identity shifts. I'm good with money now, I proved it. So, you loosen the belt a bit. You start upgrading little things, nicer clothes, better dinners. You stop checking prices as closely. You tell yourself, I'm not broke anymore. I don't need to obsess over every dollar. You finally feel like a responsible adult with money. But there's a catch. That new identity can trick you into relaxing the exact habits that got you here. You're not doing anything outrageous. That's what makes it sneaky. A subscription here, a nicer apartment there. You start saying, I deserve this more often. And honestly, you do deserve nice things. That's not the issue. The issue is that your fixed costs quietly drift up until they're almost equal to your income again. Suddenly, your extra money disappears, and that 20,000 is doing all the heavy lifting with no backup. This is where a lot of people will say, okay, Joe, If money is still stressful after 20,000, then what's the point? I thought that number was supposed to calm everything down. It does calm some things down. You're not panicking about a flat tire. You're not counting every coffee. You're no longer one bad week away from overdrafting. But if you let lifestyle creep eat your new margin, you've basically traded one type of stress for another. Instead of, will I be able to pay rent? It becomes, am I going to screw up this chance to finally get ahead? And here's the really annoying part. The rest of the system is very, very happy to help you screw it up. Once your balance looks respectable, you become someone else's business model. Your bank suddenly rewards you with offers, a premium card with a fee that's only a few hundred a year, a personal loan you can use to finally do that home project, higher limits that come with higher risk. Your broker or investment app promotes featured funds that happen to have higher expense ratios. Fintech apps push round up and invest, or fancy robo upgrades that skim a little extra each month. Your feed congratulates you with ads, new car deals because you've earned it, travel points cards that pay for themselves, buy now pay later on furniture, electronics, you name it. Your bank and the ads in your feed will congratulate you for building savings. But there's a catch. Most of their rewards are just ways to skim a little piece off your new safety net every month. Quick math. As of early 2025, Experian's auto finance data says the average new car payment in the US is about $745 a month. Over a 5-year loan at that payment, that's nearly $45,000 leaving your pocket. And new cars drop fast. One breakdown from Ramsey Solutions points out that a typical new car loses roughly 20% of its value in the first year alone. So, you're taking tens of thousands of dollars, money that could be buying you options later, and parking it in your driveway where it's quietly melting. At the same time, as of late 2024, average credit card interest rates are around 24 to 25%. That means if you let lifestyle creep push you into carrying a balance, your interest rate is basically a bonfire for future use money. Then there are the fancy funds. Simple index mutual funds that just track the market can have expense ratios as low as about 0.05%. Data from the Investment Company Institute says comparable actively managed equity mutual funds are around 0.65% on average. Quick math again. On a 20,000 investment, 0.05% is about $10 a year. Around 0.65% is roughly $130 a year. That difference keeps compounding every single year, just because you bought the expert-picked fund instead of the boring one. None of this feels dramatic in the moment. It's just a car, just a card, just a fund, just a small bump in rent. But put all of that on top of a savings rate that's already low, and you can see why so many people hit 20,000, feel grown up for a year, and then wonder where all the progress went. So, how do you enjoy any of this without nuking the base you just built? Here's the simple mental model I wish I'd learned at 22. Once you hit that first real milestone, maybe 20,000, maybe a bit less or more depending on your cost of living, you stop thinking of it as savings and start thinking of it as layers. Layer 1 is the floor, layer 2 is growth, layer 3 is fun options. The floor is your never go below this again money. This is your emergency fund. Rent, food, bare minimum bills for a few months. How many months depends on your situation, but that 3 to 6 months range you always hear about, there's real data behind it. That same kind of Vanguard research found that having 3 to 6 months of expenses saved, on top of that initial buffer, was tied to a big drop in stress and a bump in overall financial well-being. For a lot of people in the US, that ends up landing somewhere near 15,000 to 25,000. Above that floor is your growth layer. That's the money whose job is to buy you freedom later. Investments for long-term stuff, retirement, work optional years, maybe future housing. Above that is your fun and options layer, upgrades, trips, taking a course to pivot careers, helping a friend start a business, moving cities. All the things that actually make your life feel better now or create more upside later. You absolutely should enjoy some of your money once you're past that first 20,000. But there's a catch. The fun has to come from the layers above your floor, not from the floor itself. Quick math, let's say your monthly bare bones cost of living is $3,000. 3 months is $9,000. 6 months is $18,000. So maybe you set your floor at $18,000 or $20,000. If you have got $26,000 saved, That extra 6 to 8,000 is where both growth and fun live. Maybe you decide 4,000 goes into investments and 2,000 is for actual life enjoyment over the next year. The rule is simple. You can juggle between growth and fun as your priorities change, but you do not dip below the floor unless it's a genuine emergency. And yes, genuine emergency doesn't mean flash sale on flights or I'm bored with my phone. I can already hear someone in the comments. So, Joe, am I just never allowed to touch this money? What if I need a down payment for a house or to move to a better city? Here's how I think about it. If using some of that floor money raises your long-term income, lowers your fixed costs, or significantly improves your safety, then maybe that's not fun. That's investment in your life. But even then, I'd aim to rebuild the floor immediately after, because that's what keeps you from falling right back into phase one panic. The floor is not a trophy. It's the foundation of every decision you make from here on out. Now, there's another trap that shows up once you finally have a decent chunk of money. You log into your investing app, and for the first time, the graph looks impressive. You see 5 figures, maybe even high 5 figures if you've been grinding. You start thinking, okay, but how do I speed this up? How do I get from 20,000 to 200,000 fast? And the internet is so happy to answer that question. Options, meme coins, leveraged ETFs, penny stocks. That guy on TikTok who turned $500 into $2 million trading momentum breakouts in 2021. Once you've got real money in the game, it's tempting to start swinging for the fences. But there's a catch. One smart bet gone wrong can erase years of slow, boring progress. And here's the painful data on this. In 2024, the S&P 500 returned about 25%. Albar's investor behavior study says the average equity investor only saw around 16.5%, almost 9 percentage points less, mainly because they jumped in and out at the wrong times. That's just 1 year, but it lines up with the longer-term pattern. That gap isn't because people are dumb. It's because we're human. When you watch a 20,000 portfolio swing by thousands of dollars in a week, your emotions get loud. Fear when it drops, greed when it spikes. And if you put your floor money into high volatility stuff, those emotions get unbearable. So here's the rule I use. The floor lives in cash and very boring, very safe stuff. The growth layer mostly lives in diversified, low-cost index funds or similar simple strategies. The I want to play around experiments live in a tiny slice of the fun options layer. If you want to throw 5% of your portfolio at something spicy once you're stable, that's your call. Just don't pretend that gambling is a retirement plan. The goal isn't to never take risk. Risk is how you get paid. The goal is to never let one dumb risk take you back to zero. Let me put all of this into 2 stories. 2 people, same country, similar income. We'll call them Alex and Jordan. They both hit 20,000 in savings in their early 30s. Alex sees 20,000 and thinks, finally, I'm not behind anymore. They upgrade their car, move into a nicer place at the top of their budget, grab a couple of premium cards for the points, and dip into savings here and there for trips and gadgets. They mean to invest more once things settle down, but things never really settle. Sometimes they're at 25,000, sometimes they're back at 8,000. Their retirement account grows, but slowly. By their 40s, they're making decent money and still feel like they can't say no at work. They have to put up with the bad boss, the unpaid overtime, the anxiety, because that savings cushion just isn't solid. Jordan hits 20,000 and does something different. They decide, this is my floor. I'm not going below this number again unless the universe throws something truly serious at me. They keep their car boring. They keep housing costs reasonable. They don't chase every lifestyle bump their coworkers do. They push new savings into that growth layer, simple index funds, boring retirement accounts. As of the end of 2023, Vanguard's How America Saves report shows the average retirement plan account they administer at about $134,000. The median is only around $35,000. In other words, a lot of people in their 40s and 50s have way less saved than you might think. Jordan decides they don't want to be in that median group at 55. They also use some of their fund/options layer to buy career flexibility, paying for a certification, taking a short income hit to move to a role with better upside, saying no to some nonsense at work because, worst case, they can survive months without a paycheck. One 2025 survey from the interview guys found that 44% of employees stay in jobs they dislike because their salary feels like their main security. Jordan doesn't want to be in that 44% forever. By their late 40s, Alex and Jordan can have almost the same income on paper, but completely different levels of freedom. Alex is stuck saying yes because dropping to zero would knock them off a financial cliff. Jordan can say no because their floor and growth layers are doing their job. Some of you might be thinking, this feels like a rich people problem. I'll worry about this level 2 stuff when I actually get there. Here's the part I wish more people were honest about. Most people do reach something like 20,000 at some point in their lives. A bonus year, an inheritance, a few good years in a row. The question is not, will you ever touch 20,000? The question is, when you do, will you treat it like a trophy or like a foundation? And that brings us to the last upgrade, how you actually see money. When you're stuck in phase 1, money is about stuff. Can I buy coffee today? Can I afford the flight? Can I get the car that doesn't sound like it's dying? After 20,000, the real upgrade is that money can start being about options instead. Options like taking 3 months off between jobs without panicking, moving to a different city that fits you better, working 4 days a week instead of 5, walking away from a boss who treats you badly. Life really does get easier after that first 20,000, but there's a catch. Whether it keeps getting easier depends way more on your next few choices than on the number you hit today. If phase 1 was about escaping chaos, phase 2 is about not drifting back into it, just because everybody told you you're fine now. So here's the simple playbook. First, decide what your real floor is, how much you need to feel safe for a few months. Treat that number like a line you don't cross downwards without a very good reason. Second, build a growth layer above that, boring, low-cost investments that quietly work while you're living your life instead of staring at charts. Third, give yourself a fun options layer so you can actually enjoy your money and make bold choices without raiding your foundation. Fourth, be suspicious of anything that gets more aggressive about selling to you once your savings grow. If a product, a car, or an opportunity eats your floor or your growth layer, that's not a reward. It's just the system taxing your progress. And finally, when you do screw up, and you will, I have too, treat it like a detour, not proof you're doomed. Rebuild the floor, restart the plan, keep your eye on the options you're buying, not the stuff. Because the real catch with money is this. The number in your bank account matters, but the rules you set for what happens after you hit that number matter even more. You don't need to become a finance genius. You just need to protect your first $20,000 like it's the floor your future life stands on, and refuse to let the world or your own impulses turn it back into a finish line.